Today's market rally is being compared to the go-go days of the dot-com frenzy, in part because of the role of the retail investor. At the end of the first quarter of 2000, the S&P closed at 1498. Today, it sits at 3580. That is a record. According to S&P Global, 20 years ago, tech stocks made up 34% of the index. Today, it's 29%, although there's tech stocks that we don't call tech stocks now, so it might be higher. Back then, Microsoft was the most valuable company. Howard Ward, CIO of Growth Equities at GAMCO, was an active investor back then. He joins us now to highlight his concerns and tell us where investors can still find value. Howard, great to see you. You navigated that market back then fairly well. You're hearing the echoes right now. How concerned, I guess, are you at this point?
Well, I want to make one comment on I think the biggest difference between now and then has to do with interest rates. In 1999, the 10-year Treasury was going from 4.75% to 7%. And today we're at 65 basis points. This makes a huge difference in what the present value of future cash flows are worth. When you talk about sentiment and some of the ridiculous market activities of 1999, IPOs are a good gauge for that. In 1999, we had 486 IPOs. And so far this year, I think you're just barely over 100. I think that tells you something. Today's companies are much more profitable than then. And I think that the metrics then, we went from price per pop to price per eyeball. I think we're a little bit more sophisticated now than we were then. GDP growth back then was 4.7%. This year, we're negative 6%. Next year, we could be positive 5%. But in August, we had the stock split mania, Tesla, Apple, we had the run in Zoom and some of the other more than pandemic-proof stocks. That was very much a red flag. We're at a high on the S&P. I do think that, be very careful putting cash to work here. We're heading into the difficult seasonal time for the market with an election looming. So I probably would be hesitant to put cash to work here. I probably think you're going to find a better time to do that between now and year end.
What's fascinating, Howard, is we were also back then at the end of a very strong economic cycle, right? You have very low unemployment and everything else. And right now you have a lot of this kind of excitement about growth tech stocks and everything else and high valuations. At the same time, we have an early cycle kind of recovery mode happening, too. How does that play into things?
So, yes, I mean, one of the commonalities is the sort of increasing infatuation with technology stocks. But I'm just going to I think that it's a little bit difficult now to talk about a brand new expansion beginning because the one that ended, courtesy of COVID, ended so abruptly, and it was really almost a 2-month hiccup. It happened to span 2 quarters, so it's a recession. But it's almost artificial in some sense. It's not like anything we've ever seen in the past. So I really sort of view this as more of a continuation of what had been the economic expansion that began in 2009, even though technically it's not.